Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for October 25th, 2022. It's great being with you here today, and we're going to talk about both housing prices and consumer confidence. Let's jump in with housing prices. We saw a significant decrease in August, down over 3% month over month. What happened? Yes, we saw all the cities in the index falling. So before we had seen active markets aggressively moving, then we saw a little weakness in the West Coast, and now we fully see the impact of higher mortgage rates and concerns about the economy weighing on the purchaser. If we go year over year, up 13%. Yes, still a strong number, but significantly off the 21% we saw at the peak in June. What does that tell us? That tells us that people are backing off, that the sales numbers have fallen. Yes, we have seen a decrease in inventories, meaning people are not listing as they listed houses before. But this is a good sign for the Fed, which is now can be a little bit more cautious, given that housing inflation is not as rampant as they may seem. Housing inflation being made up of both prices and higher mortgages. Higher mortgages are here to stay, however, maybe not the higher prices. And so for the housing market, which was completely underinvested in 2010 decade, what does that mean? It means maybe a more normal market coming forward. Reasonable price gains, reasonable affordability, and an opportunity for new construction to come back. And that's a number we're going to eye later this week as we see the GDP equation, with residential investment being a key component there. Let's switch gears. Let's switch gears to weakness that we saw in consumer confidence, mostly on the present situation. That's been actually pretty elevated because people see a plentiful job market. Now, expectations stayed about level, but we did see roughly a 12-point decline from 150 to 138 for the present number. And remember, 78 is where we are for expectations. So the present situation's always been better throughout this whole pandemic for the consumer, and it's been the driver of purchases and activity, particularly as the consumer has been spending their stimulus and expending their money they get from new job opportunities. Where was the drive? Yes, it is that expectation that the economy will be bad, 24% versus 20%. Employment plentiful drops to 45 from roughly 50, and we see jobs hard to get, moving up just a touch. Around 12% of the survey individuals said that. So yeah, a little weak, but I would suggest if you go down deeper into the numbers, you see actually a ramp up. 12%, 0.4, say auto purchases in the next 6 months. That's up from 10. And remember, dealerships are struggling with stock, and we're also seeing people pay over list, which we hadn't seen before the pandemic started. In terms of homes, yeah, a shoot up. Almost 7% of people saying now been running around 5%, and appliances running at 50%, which is up from 46%. So the numbers on the purchase side continue to be healthy. So yes, a little bit of headwind for the consumer, a little bit of concern for employment, but net purchases seem on track, and I think that will bode well for the economy ahead. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.